Trump and Netanyahu have attacked Iran. Oil prices are already jumping. The Middle East is on fire. And for investors in the United States, this raises a serious question. What does this terrible situation actually mean for your money? Because when conflict erupts in one of the world's most important oil regions, it doesn't stay local. It spreads through the global economy. Energy prices move. Currency moves move. And eventually, the stock market reacts. So in this video, I'm going to break down three things. First, the direct effects this war could have on financial markets. Second, the indirect ripple effects on stocks, gold, oil, and the US dollar. And third, the long-term reality for US investors and how to protect your portfolio. Second, the indirect ripple effects on stocks, gold, oil, and the US dollar. And third, the long-term reality for US investors and how to protect your portfolio. Now, when it comes to direct effects, meaning predictable effects where war begins and markets react, I really only see two. The first direct effect has to do with geography. Southern Iran borders the Persian Gulf and the Gulf of Oman, which then opens up to the Arabian Sea and the rest of the world. Between those two gulfs, there is a narrow corridor of water called the Strait of Hormuz. Around 20% of the world's oil production passes through this strait every year because many of the world's most productive oil fields in Saudi Arabia, Kuwait, and Iraq sit behind it. So if the strait is closed to traffic, that can have a dramatic effect on oil prices. Iran has announced that they are closing the Strait of Hormuz. Right now, as I record this on Monday morning, if I look at Brent or crude oil prices, I see that they are up about 9.3% over the past 5 days. That's a very significant move. And when oil prices increase, it can have a major impact on almost every other financial market. We'll discuss that in a second, but the point is that this effect is direct and very clear. When the war starts, oil prices go up. The only other direct effect I see is that if Trump is starting another war, that will likely mean more money for weapons manufacturers and defense companies. Companies like Northrop Grumman, Lockheed Martin, or Raytheon. When rockets are fired, they eventually need to be replaced. And that means governments spend more money on defense equipment. Now, does this mean you should rush out and buy defense stocks? Well, not so fast. There are two reasons to be cautious. The first reason is a moral one. Do you really want to build your wealth off suffering, misery, and war? Personally, I don't. But even if that is not a concern for you, there is a second reason. Investors are not stupid. For the past year, it has been obvious that Trump is not exactly a president of peace. Markets have already been pricing in the possibility of conflict. So the stock prices of many defense companies have already increased significantly. That means if you jump in now, it's entirely possible you are simply arriving too late. Because in most cases, the relationship between war and stock markets are not direct, they're indirect. Now, there are exceptions, of course. If massive conflict breaks out in a developed economy with a large stock market, like during World War II when Western Europe was invaded, that can devastate markets. But if a war happens in a relatively remote region and stays contained, the effects on markets tend to be indirect. Which brings us to the second part of this video. What are the likely indirect effects of the Iran war on stock prices and financial markets? From a humanitarian perspective, war is always a tragedy. You might intuitively think that war is bad news for the stock market and that prices should fall. But historically, that is not always what happens. Often before a war, when investors become nervous, stocks may drop. But once the war actually begins, markets sometimes recover surprisingly quickly. For example, when Russia invaded Ukraine, Western markets initially dropped, including the S&P 500. But within a short period of time, the market bounced back and actually performed quite well over the following month. With regional wars like this, what investors really care about is the long-term economic impact. And in this case, the key question is inflation. Global inflation is heavily influenced by energy prices. So if the Strait of Hormuz remains closed for an extended period and oil prices stay elevated, that could push inflation higher in the United States and around the world. Now, I'm not a military expert. Some analysts say Iran will not be able to keep the strait closed for long because their ships and military infrastructure would likely be destroyed. Others say it doesn't take much to disrupt shipping. A few rockets here and there can already make companies reluctant to move oil through the region. So it's hard to predict. But if energy prices remain high for a long time, that could create inflation pressure in the US economy. Looking at history, there are examples where this had a very negative effect on markets. During the 1970s oil crisis, conflict in the Middle East led to reduced oil production. The result was stagflation, a combination of economic stagnation and high inflation. And that was terrible for stock markets. The 1970s became a lost decade for many investors. However, the world today is very different from the 1970s. Today, the United States is actually the largest oil producer in the world. And Middle Eastern countries are not a unified bloc the way they once were. Many of them are not particularly friendly with Iran and may not support actions that push oil prices higher. It's possible we see some disruption and some inflation pressure. but the US and other producers could increase output and reduce the long-term impact. We'll only know how this develops over the coming months and years. As Warren Buffett famously said, the only value of stock forecasters is to make fortune tellers look good. In other words, nobody can reliably predict what markets will do. But there are still things we can do as investors to protect ourselves. Before we talk about that, let's look at another indirect effect. This conflict, the price of gold. Gold has surged in recent years as investors and central banks look for protection from geopolitical risk and diversify away from the US dollar. Trump starting another war certainly adds to that narrative. As of Monday morning, gold prices are up roughly 3% over the past week. But that doesn't necessarily mean you should rush to buy gold. Because again, once news becomes widely known, markets quickly price it in. Many investors who wanted gold as protection from geopolitical risk already bought it over the past few years. So trying to trade on the news after it happens is extremely difficult. You are competing with millions of investors around the world who are analyzing the same information. The third indirect effect of the war is the impact on the US dollar. Historically, when global conflicts erupt, the dollar often strengthens because it's considered a safe haven currency. Investors move their money into US Treasury bonds and other dollar-denominated assets. There is also another factor. Because the United States is now the world's largest oil producer, higher oil prices can increase global demand for dollars, and that can strengthen the currency. Looking at the dollar-euro exchange rate, over the past 5 days, the dollar has strengthened by about 1%, but that is not an enormous move. And the situation is more complicated than usual. Over the past year, there has also been a narrative that some global investors are moving away from the dollar due to political uncertainty in the US. Some are diversifying into gold, other currencies, and other markets. So in this particular crisis, the behavior of the dollar may be less predictable than in the past. Now let's talk about the long-term impact of this conflict and what US investors can actually do to protect themselves. The reality is that global financial markets are incredibly complex systems with millions of variables. If anyone tells you they know exactly what will happen next, they either don't understand markets or they're pretending. What we can say with some confidence is that we are entering a period of higher volatility, higher uncertainty, and higher geopolitical risk. As long as Trump remains in office, we are likely to see more surprises, more disruptions, and more geopolitical tension. That does not automatically mean the economy will perform badly or that stock markets will crash. In fact, as uncomfortable as it may sound, even wars sometimes end up benefiting certain industries and economic activity. But it does mean there will likely be more chaos and more volatility. And volatility means both risk and opportunity. The key is surviving the risks so you can benefit from the opportunities. So in uncertain times, it's important to go back to the basics. First, make sure you have a solid safety cushion, an emergency fund. This is cash that sits in a high-yield savings account can cover unexpected expenses without forcing you to sell your investments when markets are down. Second, make sure you are taking the right level of risk for your age and financial situation. If you are 30 years old, financially ambitious, and comfortable with volatility, you might choose to keep most of your money in stocks. But if you are 55 or 60 and approaching retirement, you probably shouldn't have 100% of your savings in stocks. You should have a balance between equities and safer assets like bonds. And the third rule is diversification. You can certainly make concentrated bets on specific sectors or markets. But if your goal is protection in an uncertain world, diversification is usually the smarter strategy. Invest across different industries, different regions, and hundreds or even thousands of stocks and bonds. The world has experienced many geopolitical crises over the past century, and investors who stay disciplined, diversified, and patient have historically come out ahead.